So in this video, we are going to cover a real-life situation that we recently encountered where an individual, really nice guy, had called up the office and he knew what he wanted. He would like to see some numbers. Now, when I say he knew what he wanted, he knew the direction he wanted to go, but he wanted to see still a number of options. And really what we're going to focus on in this video is validating information, because he wanted everything validated. Also, we like to show everything in a simplistic manner. So we're going to go through first what he wanted and then what we did with looking at the simplified spreadsheets. This way you can compare and contrast the different options. You're going to see something really neat here too in respect to how to really beef up the internal rate of return of a policy, but then also how to validate that with detailed illustrations. So, details on the case. He is 41 years old. He initially was considering a $1 million lump sum. However, as we've continued to have conversations with him, he says, hey, I'd like to see $1.5 million going into the policy as well. Okay, so I asked him the question, the $1 million lump sum that you're considering, is that the total dollar amount you'd like to get into a policy? Meaning, once you pay it in, you say, I am done. I don't want to be on the hook for not a dollar more to go into this policy. Or is there a chance you might want to continue to add to the policy, especially due to the fact that it's over the expenses? And his response was, I might want to continue to add to it, but I'm pretty sure I'm going to want to stop altogether. Okay, so just from experience, I've seen a lot of people go both ways, where they initially came in, said, hey, I want to pay this much in, and then I'm done. And then some people say, I want to pay in forever, and then they stop early. So he's pretty certain with respect to what he wants to do right now, but he did say, I might want to keep going. So as we put the options together for him, I accounted for that, which is important to do, and we really make it a point to do it with everyone we work with, because life happens. Like, it happens to me, to everyone, like, you can't control it. Now, he did state that my goal, Steve, maximum internal rate of return. That is what I want. That was his goal, so I really made it a point to focus on that. And to simplify that, what maximum IRR really represents is, how do I get the most cash value out of my policy? Here's the dollar amount I'm paying in. I want the most possible. Show me options. That's really why he had called up after doing research. Now, he was pretty certain of what company he wanted to go with. And I had asked him questions on different companies, and just to shorten the conversation that him and I had, he said, I'm pretty comfortable with Mass Mutual. That's the direction I want to go. And we use Mass Mutual, Guardian. We recommend the 4 major mutual companies, even though we can't use Northwestern Mutual because they only work with their career agents, not brokers. There's still quality in that respect. But Mass Mutual, he said, that's the direction I want to go. Understood the flexibility, all the important bullet points. Okay, progress on. Products. This is important here. Initially, we showed a number of options. When I say a number of options, this is probably my OCD, but he said he wanted to see some options there, is I showed 6 different variations. An L100, a 10-pay with LISR, which really gives flexibility with Mass Mutual, then one without LISR, which was a trick we used with the illustration software to maximize the performance. Not that it's a trick, it's just not that well known by a lot of people in the business. That's what I'm going to show you here. Then their 20-pay, higherly cash value, and then also their 12-pay we showed as an option too. But what we eventually narrowed things down to were the L100 and 10-pay product, but pre-7702 change. So that's still available if someone submits an application on or before November 19th. That particular product right there, before the 7702 update fully goes into effect in 2022. But why I mention that is Mass Mutual's limited pay products, when a reduced paid up option is exercised, give a nice advantage that a lot of people are not aware of. With that said, they usually make sense if someone's not that interested in policy flexibility, or they don't really need it, and they're dealing with a lump sum. You'll see what I mean when we look at the numbers. In this particular unique situation, it made sense. And if you're watching this video in 2022, it's not even available anymore, this particular version of it. But wanted maximum internal rate of return. The first variation of scenarios we showed was a 4-pay. What that means is breaking the $1 million up over 4 years, which would be what? About $250,000 per year. That was the 6 options I mentioned. He said, okay, thank you, got it. I'd still like to see a 7-pay and a 10-pay, meaning he wanted to see the 1 million broken up over 7 years and then also over 10 years. Okay, he wants to see exactly what the internal rate of return would look like. As we look at them side by side, we put the different options together. Then he said, okay, this makes sense. Let's focus on the 4-pay, the one that gives me the most money, and show me 1 million and also 1.5 million. Very interested in both of these. Annualized internal rate of return and also the average internal rate of return. Okay, so let's get into the numbers now. Again, what's his goal? As most cash value as I can possibly get, or the maximum amount. So what we will start with here, the $1 million lump sum based on dividend values, optimized internal rate of return. So we've narrowed things down at this point in time to the Legacy 100 option and the 10-pay option. Here's what I want to touch on. A recap of both options. This way he has full awareness on the pros and cons of both and can make an informed decision. The Legacy 100 product gives him the ability, gives anyone, to continue to make payments up until age 100 if desired. This particular product, the way we designed this L100, is designed with maximum flexibility. So how it's designed, MassMutual will allow him to adjust his payments 1 time per year, every year, provided the adjustment fall on his policy anniversary date. So if he started his policy on 10/24, October 24th, then October 24th of each year, when his premium comes due, is when he can adjust the payment. For example, year 1, let's say he pays in $250. Year 2, things slow down. I don't have the full amount. I only want to pay in $100K. Maybe it's $50K, whatever. He can do so. Year 3, maybe it's back to $250, then $125. He can bounce up and down if the policy is set up properly, which our All About MassMutual video covers exactly what that means very thoroughly. Break even, year 5. This particular product does have a 10/90 split. We're going to validate that shortly in this video. Annual internal rate of return, average internal rate of return. Annual isolates what the actual growth rate is each year. The average says, okay, over the past 10 years, I averaged a little over 2.5% on the internal rate of return. Last advantage to the Legacy 100 product. You can continue to make payments as long as you want. We touched on that earlier. Here's the big thing. As you look at this policy, you break even year 5. What is the worst part about this policy? If this is you, what's the worst part about it that you dislike as you look at the numbers? 250 goes in. I've got about 219 in the first year, which is a negative 12.25 hit, 12.26%. Nobody really likes that, right? $30,000 gone off the top. Like that hurts no matter who you are. Second year, 250 goes in. Do I get the full 250 back? No. My actual growth rate that year, negative 4.36%. The following year, I pay in 250, I get that back, plus another 0.5%. Gets stronger and stronger. I'm beyond the first 2 years. With the Legacy 100 product, the company's overcharging me for the $25K base premium, 10% in this example. That is why I'm negative in the first 2 years. Then gets better and better each year. So where I'm going with this is you mentioned earlier, Mr. Client, that there's a chance you might want to continue to make payments. If that exists, or if you think that may become a reality in the future, the advantage to this policy is you can continue to pump money into it as long as you like, especially beyond 10 years. Why I mention that is as we progress to the 10-pay, a 10-pay product will allow premiums to be paid for, guess how long? A maximum of 10 years. Now, this 10-pay on the right is designed with limited flexibility. We had showed him earlier an option with more flexibility, but it gave up some performance. And that's very, very specific to the 10-pay, but limited flexibility. It's very easy for him to decrease payments. It's difficult for him to increase them with this particular design. It's possible, but it could require medical underwriting and some other things. So here, same out of pocket. If he's got a lump sum of $1 million, just transferring it from cash into this, he's good. Like, that's where this can work out in this particular case. Breaking even between year 5. Why we design it with limited flexibility is so we can maximize MassMutual's limits with that 10% minimum premium. So maximizing the products and the limitations that are offered to us by the insurance company. What do you notice here? Look at this. Here's what gets everyone's attention. And the agent that was actually working this case with has a Wall Street background. He works for our company with us, and he has been on Wall Street actually for about 20 years. So he's got a finance background. The question that he asked me specifically, which means you know the client's going to ask it, and I asked the same question to the insurance company the first time I saw this, is how on earth, in this case, MassMutual with a 6% dividend interest rate, crediting an annualized internal rate of return north of 6% when a dividend rate is a gross rate and the IRR in every other case is lower than that. How is that possible? Is the spreadsheet wrong? Like, that's the first thing that's going to come to someone's mind. Come to my mind if I'm looking at that. So to answer the agent's question, how that's possible, this did not always exist, and it won't beginning 2022 when the pre-7702 limited pay products are gone. When MassMutual updated their products in 2020 with the mortality table update, their limited pay products are a bit different. Specifically, what happens is a portion of the payments are held in escrow. That's how they explain it. And if you go reduced paid up, very specific to their limited pay products, that's where you'll see a nice temporary enhancement on the internal rate of return. So while I explained it there, you might kind of be going, okay. And if I just go motor mouth like that and explain it to someone, the reaction is probably going to be, okay, is it real? Can I see it from MassMutual? Like, that would be my reaction at the end of the day. So what we like to look at here is a full illustration. And why don't we do this? So first, we'll validate the design. So Mr. Client, here is the 10-pay option, whole life legacy 10-pay. What we've got here as far as a breakdown in respect to where your money is going. So if I'm you, the question I would ask, where's my money going with this policy? You've got $250,000 per year going in. Money can be directed toward the premium, right here, $25,000 per year. Based on the total desired payment of $250,000, this is as low as this particular company will allow me to go. Then, that was your base premium. This column, renewable term rider. So we have a term insurance rider attached, about $7,900 per year. That is a level term rider with MassMutual right now for the first 10 years. However, if things go sour, if I looked at the guarantees, they actually reserve the right to increase that. Doesn't really happen, but it is possible. However, we showed them the guarantees too. But there's the $7,900 term rider premium. And then here, Ailer, dumping money into PUAs, paid up additions, baby. Net cash value, right off the bat. Values match the illustration. Death benefit. He says, hey, the death benefit's all well and good. I'm interested in the cash value. Where'd you come up with the $6.8 million? Where we came up with it, the death benefit and your age has a direct relationship to the MEC limit on a policy. If we trigger a MEC, we lose the tax benefits of a whole life insurance policy. Core benefits and why he was interested in the product in respect to the cash value. Cash value, what are they? I know I repeat these frequently. Safe, liquid, You can access it anytime. And tax-free. One of the ways it would not be tax-free if we do everything right, one of the ways it would not be tax-free is if we triggered a MEC. That MEC limit, which is the maximum we can pay into a policy per year, has a direct relationship to the total death benefit on a policy. For a 41-year-old male, about $6.8 million in death benefit gives them almost $250K in MEC limit, a little bit more. So, policy design, validated. Now, let's go back to the agent's question, which was internal rate of return. Year 11, you're at 6.15, like how? How is that possible? We gave the explanation, but basically here, we just want to validate it. So did you know that all insurance carriers provide this information directly? And if you've worked with us before, or you have a policy with us, you know that we always like to show the detailed illustrations in addition to the simplified spreadsheets, because it's very helpful. Let me go a little bit higher here. Capture everything. There we go. So the year 11 IRR was what? 6.15%. Directly on the illustration. There you go. And that's important. So quick tip, if you're in the business, whenever you're showing numbers, if you're using some type of system to try and make things convenient for the client, I'm all about client convenience. Very important. You also have compliance to deal with, which is a biggie in any kind of financial space. And also you have client validation. They want to know that it's real. So always make sure you're providing the illustrations, making it convenient, pointing at the main pages. It's extra work, it's extra time, but I know in a case like this, it's heavily appreciated. In any case where someone really wants the details and they're questioning you, it's great to show. So 1 year rate of return with mass is the annual IRR that we had on the Excel spreadsheet. So as we go back and forth, or you can rewind, you'll see that everything matches up. And then the average internal rate of return, if we want to go back here, perfect. So we look at the same point in time, let's do this actually, year 15, you're at 3.96%. So average internal rates of return, the formula for that is tricky, especially if you're going to stop funding it earlier. So rather than risk messing something up, what we do is I do pull it directly from the insurance company software. So that's the cash value increase. There we go. Internal rate of return. So the values will match up. And our year 15 IRR was what on the Excel spreadsheet? Was it this? 3.96%. I'll scroll down if you want to kind of cross-reference and such, which is always fun to do, 3.96%. Because we just pulled them directly from the PDF and put them on the Excel sheet for simplicity. So, limited flexibility, very healthy internal rate of return as the years pass. A way to kind of simplify things for him as he makes his decision between the two is if your goal truly is to maximize that IRR and you're moving that lump sum from cash into this product, that 10-pay is attractive. It really is. But if you like the idea of constantly feeding the beast, keep on adding more money into the policy, and you like the flexibility, the IRR over here tops out at about 4%. So the question is are you more attracted to a product where you're earning, call it 3.5% to 4% on the internal rate of return based on the present dividend, but you can continue to pump as much money into the product as possible, call it at a 4% IRR, or a product that produces almost 4.75% on the internal rate of return, but you've got a limited or a short window to actually get that money in. And that's a nice question to ask just to really see where an individual's at, where their thinking's at, and what option they prefer. And of course, these IRRs are going to change over time. As the dividend rates change, we like to run them conservative. Let's wrap this puppy up by looking at the guaranteed values. We'll focus on the L100 for this one because we did the same thing here in respect to the annualized IRR and also the average IRR, so pulling them directly from the software like we always do. What do you notice on the guarantees? Breaking even between years 10 and 11. If you're looking at the 10 pay and saying, what's going on here? That premium increases. That has to do with that renewable term rider. When you look at the guaranteed rates of that, it increases. With LISR, Mass Mutual's 1-year term rider, the rate increases, but you can keep your payment level very, very easily, which is a nice advantage if you like that flexibility. So here you go. In the black, no longer in the red, year 11. Guaranteed though, which is still good for a break-even point based on the guarantees. But here, how do we validate that? 0.032%. So here's your L100, guaranteed values, $25,000 minimum premium. All right, there's your design. Let me zip down. There you go. 0.032%. A lot of info. But at the end of the day, as we go through the different options, what we're doing is presenting different options, making it convenient for the client. He had a lot of questions, but now he's got that feeling, okay, I went through everything possible because he wanted to. Now he gets it and can move forward. So if that's something that you want to do, yes, you should absolutely be entitled to doing so. It's your money going into a product. So I do hope that this video provided some value. Hope you had fun with it. I did. I love getting into the weeds like this and really pulling different levers to juice the cash value in a product and flexibility. If you liked it, please hit the like button, subscribe for more, and as always, I do hope that this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.